Hey, Saretsky here. Welcome back to the show. I want to touch on a few things today. I just got home from Toronto where I was doing a speaking engagement at the Veritas Housing Conference. If you're not familiar with Veritas, they're one of the largest Canadian equity research firms out there. Obviously, the clientele is quite sophisticated. So they put on this event every year, and it's predominantly geared towards financial institutions, money managers. So it's interesting because the conversation around the housing, like the panel that I was on, was a panel where it was sort of housing bears versus housing bulls. It was basically two sides were tasked with forming a debate around the bullish narrative and the bearish narrative. And basically, what is the outlook for home prices in Canada over the next 12 months? Will they be lower or will they be higher? And they could be $1 higher, it could be $2 higher, but will they be higher? Will they be lower? And just getting both sides of that argument. And it's funny because, we had private dinner before the event and things of that nature. And you're kind of going around the table and, the people that are sitting in these chairs are managing billions and billions of dollars. And it's just a really good conversation to hear the different perspectives out there. And I'll tell you this, there was no clear consensus around where home prices are going to be 12 months from now, which I want to really highlight this point because you come to places like YouTube and listening. I'm just trying to do my best to put out my opinion and the intel that I have on the housing market. Some of it's right, some of it's wrong, but you get everyone that's, comments in the YouTube channel here that has a clear conviction. They know exactly where home prices are going to be 6 months from now, 8 months from now, 12 months from now, and exactly why you should buy or you shouldn't buy. And everybody has one side. But if you're going to take any side of a trade on the investment thesis, if you're going to take the bullish side, you better understand what the bearish side is. It's to say, if you're going to take a position, whether it be in housing or in a particular stock, you have to understand and know both sides of the argument. If you're going to take a core thesis, a core investment position, you have to understand both sides. And so what amazed me the most was to see that there was no clear consensus. You had the room basically almost split 50-50 on what the outlook was going to be. Now, there was a clear consensus that there was serious issues and serious concerns in the pre-construction market, particularly in the GTA. We all know this is where the problem is. This is where the crisis is. But when you talk about, sort of single-family detached home prices in these major metropolitan cities, we talked about the government intervention that's happening. We talked about CMHC extending the amortizations, increasing the purchase price cap. You talk about the easing of the stress test on renewals. You talk about all the government intervention. You talk about the central bank then lowering rates. You talk about central banks injecting liquidity and liquidity indexes turning up. You can really see that there is ultimately two sides to the coin. And it might not necessarily be going up on fundamentals because there are no such thing as fundamentals. I would argue that the growth that you've seen in Canadian home prices over the past decade is actually really just a function of devaluation. It is a devaluation of the currency of the Canadian dollar and of the fiat currency system. Again, if you look at home prices in ounces of gold, which is real tangible money, they've been falling in Greater Vancouver since 2005. So again, it depends on what you're denominating the house prices. Sure, house prices are going up in nominal terms, but in real terms, in real inflation adjusted terms, in many cases, they might not actually be going up. They might actually decline, right? If you get, home prices going up 3% next year, but inflation's at 4%, they're not actually really going up. It's just a function of the debasement of that currency via money printing and inflation. So understand both sides of the argument when I come out here and talk about housing and whether it's going to go up 12 months from now, or whether it's going to go down. The honest truth is, I don't know, because I am data dependent. But what I can tell you is over the next 2 to 3 months, I think we still have a lot of issues that we're working through, namely that everybody is under the assumption that lower rates must mean a rebound in housing and it must mean higher home prices. Every single buddy I talk to is saying the exact same thing. And I've cautioned this several months ago. I said, listen, maybe rate cuts will finally actually spur a spike in inventory, a spike in new listings. Sellers falsely believing the narrative that rate cuts are immediately going to be bullish for the housing market might actually cause them to put inventory onto the market and finally list product and only push inventory levels higher. That's actually what we saw. So you look at Greater Vancouver new listing data. New listings for the month of September were the highest on record outside of September 2020, which was sort of the depths of the global pandemic when 18% of all Canadian mortgages were being deferred at one point. So on the mortgage and interest rate front, you have to understand the average person in Canada does not fundamentally care or acknowledge what the bond market is. Most people don't really know what a yield curve is. And why should they? It's boring. I mean, who cares what the hell is a yield curve? Okay, but it's really important to understand because the yield curve is what prices mortgage rates in Canada. So everybody just basically, the vast majority of people that we talk to in the housing space, mom, pop, people that, again, aren't necessarily finance people. They're just people that want to own a home. They just look at the Globe and Mail and they just say, hey, I heard the Bank of Canada is lowering interest rates. That must mean lower mortgage rates. But again, that only prices variable rate mortgages. And so what you really have to do if you want to get a decent grasp on where mortgage rates are going, where they're going to be, you actually have to look at the yield curve. And that is actually telling us that right now, the yield curve has priced in. It's priced in all of the Bank of Canada rate cuts going through to next year. So the markets currently right now are pricing, they're positioning, they're expecting the Bank of Canada to bring the overnight interest rate down to about 2.5% by the summer of next year. 2.5%. Right now, we are at 4.25, down off the highs of 5%. So the yield curve, the bond market moves in advance of that. They are anticipating that they were going to get to that 2.5% overnight rate. And so you've seen that in the bond market. Look at the Canada 5-year bond yield has moved down over almost 170 basis points off of the highs. It's priced in that move. Keep in mind, there has to be a spread. There has to be a difference between the Bank of Canada's overnight interest rate, which is short-term interest rates, and 5 years out and 10 years out, et cetera. So the curve is upward sloping. So 5 years out, the bond market is already priced in the move from the Bank of Canada. And this is a good chart showing this from Desjardins, which is showing, listen, fixed rates might not actually move more from here because they've already priced in this move in the bond market. So it's really, really important because every homeowner out there and every seller and buyers are using this idea that, oh, Bank of Canada's lowering rates, that must mean my mortgage is going to go down. No, it's already been largely priced in. It's already been largely priced in. So yeah, your variable rate mortgage is going to drop, but your fixed rates today, which are call it 4.1, 4.2, 4.3, that's the rate. That's the rate. So unless the Bank of Canada, unless we enter a recession, and maybe it's a bad recession, and the Bank of Canada doesn't cut rates to 2.5, maybe they cut rates to 1.5, maybe they cut rates to 0 again, like they did for the past decade, then yes, your 5-year yield should reprice lower, and you should see fixed mortgage rates coming down. But if you go strictly off of the market expectations, which is rates to come down to 2.5%, the bond, the 5-year yield is basically, it's already there. It's already there. Now, where this gets really interesting, and this was part of the discussion that we had at the dinner table at this event, was two things. Okay, we know the Canadian economy is weak. We know that it's in worse shape than the U.S., but the U.S. doesn't really look that bad. And the U.S. bond market and the U.S. economic data is ultimately what influences rates here at home in Canada. And so the question is really, well, what if the U.S. really doesn't cut as much as we all expected to? What if the data actually holds up? And what if you start getting sort of an uptick again in inflation and economic growth? Then yields should actually move higher, not lower. And that would then influence what's happening here back at home. So this is really, really important to understand. And this is where, again, the discussion really gets interesting. Because if you look at this, it's funny, like talking about all this, and then you look what happened over the last 7 days. Over the last 7 days, the economic data in the U.S. has come out stronger than expected. We just got non-farm payrolls in the U.S. way stronger than expected. Over the last 7 days, the Canada 5-year bond yield has suddenly moved higher by 30 basis points. So again, what's happening is the economic strength in the U.S. is already influencing the bond market in Canada, which prices your fixed rate mortgages. So while everyone's out there going variable rate mortgages and I'm going to lock in when rates are lower, it might be the lows. We don't know. But what we know is the data is not that bad in the U.S. It's stronger and it's influencing yields higher. So we have to kind of anticipate this and say, okay, well, what if the Bank of Canada continues to cut rates and maybe they get down to 3%, maybe they get down to the 2.5%, but fixed rates really, they don't go much lower from here. Maybe again, 4% mortgage rates are the new 2. Maybe that's as low as they go. And so people need to expect this and prepare for this, because I think it's a realistic probability that that this doesn't move a whole lot lower. And so, like I said, I'm putting this out there because I continue to hear people in the industry, home sellers, making massive $1 million decisions based on reading the Globe and Mail headline that says Bank of Canada is cutting rates, which must mean mortgage rates are moving lower. No, it means variable rate mortgages are moving lower, but variable rate mortgages are priced well higher. They're priced well higher than where the fixed rates are today. So we have to really understand and follow what's happening in the bond market. Of course, when you really start to unpack, you say, well, we got a global conflict in the Middle East. That's inflationary, oil prices moving higher. We've got central banks injecting liquidity, which is going to stimulate growth and is going to potentially stimulate inflation, which then could ultimately push bond yields higher, which I don't think many people are prepared and expecting. So I think this is really, really important to understand. This is why I say, like, when you look at housing to start the video, the bull side and the bear side, you have to understand both cases. You have to understand both sides of the argument, and you have to be data dependent, because the data is going to change. You know, if the conflict in the Middle East ramps up and the economic data in the U.S. starts to continue to improve and get better, then this is going to influence domestic bond yields here in Canada and could completely shift forecasts around Canadian housing. So this is continuing to be a moving target, but I think it's really, really important for people that are making mortgage decisions today. Do I do 1 year fixed? Do I do 3 year fixed, 5 year fixed? Do I do variable? Well, listen, maybe you should start looking at the bond market as opposed to what the Bank of Canada is doing, because there's a lot going on behind the scenes. And again, I'm not going to go tell people, because everybody's financial decisions are different. How long you plan to hold a house for, when you're planning to move, what are you doing with the property, you know, what your liquidity preferences are. So, you know, giving someone straight advice on what term to take without understanding their situation is not appropriate. But hopefully this video has helped explain the nuances that go on behind the scenes and in the bond market in terms of how they influence what you can borrow your mortgage at here in Canada. So that's kind of what I'm keeping an eye on. Again, we saw the data in Vancouver and in the GTA continues to weaken. Again, the consensus is the pre-sale market is really where your crisis is, and we have to keep a close eye on the U.S. economic data and on the bond market for how that's going to influence mortgage rates in Canada, because that is ultimately going to be the determinant for what kind of market we have in 2025. As always, hope that helped, and we'll see you next week.